Hello everyone, welcome to the 67th episode of me learning how to trade in Forex. So in the last episode we went through what is the best technical indicator in Forex. So they did a comparison of all the indicators we've learnt so far, set some rules, and then found out like what's the profit or loss made using each strategy. And we found out that Ichimoku, Kinko, was in quotation marks the best, I guess, out of the rest, and the stochastic was the worst. But that does not mean the Ichimoku Kinko high indicators are best, or that technical indicators are useless as a whole, or as a whole are useless. Rather, they just show that they aren't useful on their own. So, when using technical indicators, it's best to just combine them together and work on from there. So yeah, and now we are currently on summary popular chart indicators, so just summarizing everything we've done so far regarding technical indicators. So everything you learn about trading is like a tool that is being added to your Forex trader's toolbox. Your tools will give you a better chance of making good trading decisions when you use the right tool at the right time. So we've got the common chart indicators we learned, the bollinger bands, MACD or moving average, convergence, divergence, the parabolic SAR, which I forgot what it actually stood for, stop and reversal, that's it, stochastics, relative strength index, average distribution, what is it called, average directional index, and the Ichimoku Kinko Hyo. Bollinger bands are used to measure the market's volatility. So bollinger bands are used to measure market's volatility, acting like mini supports and resistance levels. The bollinger bounce, a strategy that relies on the notion that price tends to always return to the middle of the bollinger bands. Bounce is a strategy which relies on the notion that price tends to always return to the middle of bollinger bands. You can buy when price hits the lower bollinger band, you can sell when price hits the upper bollinger band. Buy when price hits the lower bollinger band, sell when price hits the upper bollinger band. Best used in ranging markets. That's a bollinger bounce, so let's move that there actually, because that makes more sense. Best used in bollinger band. The bollinger squeeze. A strategy that is used to catch breakouts early. Is a strategy which is used to catch breakouts early. When the bollinger bands squeeze, it means that the market is very quiet and a breakout is imminent. Once a breakout occurs, we enter trade on whatever side the price makes its breakout. when the bollinger bands squeeze, it means the market is very quiet, and breakout is imminent. Once a breakout occurs, we enter a trade on whatever side the price makes its breakout. The MACD, the moving average convergence divergence. So moving average, I should call it MACD. MACD is used to catch trends early and can also help us spot trend reversals. Consists of two moving averages, one fast, one slow. Consists of two moving averages, one fast and one slow, and vertical lines called a histogram. Because there's two moving averages, one fast and one slow, and vertical lines called a histogram. Which measures the distance between the two moving averages. Which measures the distance between the two moving averages. Contrary to what many people think, the moving average lines are not moving averages of the price, they are moving averages of other moving averages. Distance between the moving average lines are not moving averages of the price. The two moving average lines are not moving averages of the price. They are moving averages of other moving averages. MACD's downfall is its lag because it uses so many moving averages. CD's disadvantage is that disadvantage is its lag, as it uses so many moving averages. One way to use MACD is to wait for the fast line to cross over or cross under the slow line and enter the trade accordingly because it signals a new trend. One way to use MACD. So MACD can be used to wait for the fast moving average line to cross over the slow moving average line, to cross over or cross under the slow moving average line and enter the trade accordingly because it signals a new trend. Yep. Parabolic SAR. The indicator is made to spot trend reversals. Parabolic SAR is an indicator used to spot trend reversals. This is the easiest indicator to interpret because it only gives bullish and bearish signals. Parabolic SAR only gives bullish and bearish signals. So when the dots are above the candles, it's a sell signal. When the dots are above the candles, it's a sell signal. When the dots are below the candles, it's a buy signal. These are best used in trending markets that consist of long rallies and downturns. Parabolic SAR is best used in trending markets that consists of long rallies and downturns. Stochastic. Used to indicate overbought and oversold conditions. Stochastics is used to indicate overbought and oversold conditions. When the moving average lies above 80, it means that the market is overbought and we should look to sell. When the moving average lies are above 80, it means the market is overbought and we should look to sell. When the moving average lines are below 20, it means the market is oversold and we should look to buy. The relative strength index, relative or RSI, is used to indicate overbought and oversold conditions. When the RSI is above 70, it means that the market is overbought, so we should look to sell. When the RSI is above 70, it means the market is overbought and we should look to sell. When the RSI is below 30, it means the market is oversold and we should look to buy. RSI can be used to confirm trend formations. If you think a trend is forming, wait for the RSI to go above or below 50, depending on if you're looking at an uptrend or downtrend before you enter a trade. So crossing over that 50 line. If you think a trend is forming, wait for the RSI to go above or below 50, depending on if you're looking at an uptrend uptrend or downtrend before you enter a trade. Right. The average directional index, or the ADX. The ADX calculates the potential strength of a trend. ADX is used to calculate the potential strength of a trend. It fluctuates from 0 to 100, with readings below 20 indicating a weak trend and readings above 50 signaling a strong trend. Fluctuates between 0 to 100, reading ADX readings below 20 indicates a weak trend. ADX readings above 50 indicate a strong trend. ADX can be used as a confirmation whether the pair could possibly continue in its current trend or not. ADX can be used as confirmation whether the currency pair could possibly continue in its current trend or not. ADX can also be used to determine when one should close a trade early. Can be used to determine when one should close a trade early. For instance, when ADX starts to slide below 50, it indicates that the current trend is possibly losing steam. I.e., when ADX is below, when the ADX reading declines below 50, it indicates the current trend is possibly losing steam, or slowing down, basically. Losing momentum. That's a better word. Losing momentum. Ichimoku kinko hayo. Ichimoku kinko hayo is an indicator that gauges future price momentum and determines future areas of support and resistance. Is an indicator which gauges future price momentum and determines future areas of support and resistance. Ichimoku translates to a glance. Kinko means equilibrium, while hayo is Japanese for chart. Putting that all together, the phrase Ichimoku kinko hayo stands for a glance at the chart in equilibrium. Right, okay, so this is the all the lines. If the price is above the Senku span, the top line serves as the first support and the second line serves, whilst the bottom line serves as the second support level, and the bottom line serves as the second support level. Same if it's if the price is below the Senku span, the price is below the Senko span, the bottom line serves as the first resistance, and the top line serves as the second resistance level. The Kijun Sen acts as an indicator of future price movement. If the price is higher than the blue line, it could continue to climb higher. If the price is below the blue line, it could keep dropping. Kijun Sen acts as an indicator of future price movement. If the price is higher than the blue line, it could continue to climb higher. If the price is below the blue line, it could continue to drop lower. Tenkan-sen is an indicator of the market trends. If the red line is moving up or down, indicates that the market is trending. Moves up or down, it indicates the market is trending. So trending in the direction of the lines, I think I should be including that. So trending in the direction of the line. If it moves horizontally, it signals the market is ranging. Chico span is the lagging line. If the Chico line crosses the price in its bottom up direction, that's a buy signal. If the green line crosses the price from the top down, that's a sell signal. If the green line crosses the price in the bottom up direction, that's a buy signal. If the green line crosses the price in the from the top down, in the top down direction, that's a sell signal. Each chart indicator has its imperfections. Let me just save that. This is why Forex traders combine many different indicators to screen each other. Remember to combine different indicators to screen each other. As you progress through your Forex trading career, you will learn which indicators you like the best and combine them in a way that fits your Forex trading style. Okay, leading versus lagging indicators. Leading versus lagging indicators. In the previous grades, popular chart indicators were discussed. Indeed they have. We've already covered a lot of tools that can help you analyze potential trending and range-bound trade opportunities. Still doing great so far? Awesome. Let's move on. Welcome to grade 6. In this lesson, we're going to streamline your use of these chart indicators. We want you to fully understand the strengths and weaknesses of each tool so you'll be able to determine which ones work for you and which ones don't. Let's discuss some concepts first. There are two types of indicators, leading and lagging. A leading indicator gives a signal before a new trend or reversal occurs. So, leading indicator gives a signal before a new trend or reversal occurs. These indicators help you profit by predicting what prices will do next. Leading indicators attempt to predict what prices will do next. Leading indicators typically work by measuring how overbought or oversold something is. Leading indicators typically work by measuring how overbought or oversold something is. This is done with the assumption that if a currency pair is oversold, it will bounce back. The assumption that a currency pair is oversold, it will bounce back. So if something's oversold, we should look to buy because it's going to bounce back, so we buy. But what if it's oversold and it doesn't bounce back? Is that even possible? I don't know actually. Okay. Leading indicator, that's that. Price, lead. So I'm guessing this is the, what is it? Price goes on the y-axis, isn't it? Whereas time goes on the x-axis. So the leading indicator this time wait, this graph doesn't even make sense. Because if it measures what the prices will do next. Oh no, okay, so this is the actual price, this is the leading indicator. So things will go up, and then at this time it thinks it'll go down, and then this time it thinks it'll go back up. No, wait. That doesn't make sense as well. Yeah, I don't know. A lagging indicator gives a signal after the trend has started. Indicators give a signal after the trend has started. Lagging indicators work well when prices move in relatively long trends. Indicators work well when prices move in relatively long trends. They don't warn you of any upcoming changes in prices though, they simply tell you what prices are doing, rising or falling, so that you can trade accordingly. Lagging indicators don't warn you of any upcoming price changes. They simply tell you what prices are doing. You're probably thinking, oh, I'm going to get rich with leading indicators, since you would be able to profit from a new trend right at the start. You're right. You would catch the entire trend every single time if the leading indicator was correct every single time, but it wouldn't be. When you use leading indicators, you will experience lots of fake outs. Indicators are susceptible to fake outs. Leading indicators are notorious for giving bogus signals which could mislead you. Got it? Leading indicators that mislead you? Hey ha man, we're so funny we even crack ourselves up. Oh, mislead. Alright, okay. The other option is to use lagging indicators, which aren't as prone to bogus signals. Lagging indicators only give signals after the price is changed, after the price change is clearly forming a trend. The downside is that you'll be a little late in entering position. Often the biggest gains of a trend occur in the first few bars, so by using a lagging indicator you could potentially miss out on much of the profit, and that sucks. It's kind of like wearing bell bottoms in the 1980s and thinking you're so cool and hip with fashion. I don't know what they are. It's kind of like discovering Facebook for the first time, all your friends are already on TikTok. It's kind of like getting excited by a new flip phone that now takes photos when the iPhone 11 Pro came out. Lagging indicators have you buy and sell late, but in exchange for missing any early opportunities, they greatly reduce your risk by keeping you on the right side of the market. For the purpose of this lesson, let's broadly categorize all of our technical indicators into one of two categories: leading indicators or oscillators, lagging or trend following indicators. Whilst the two can be supportive of each other, they're more likely to conflict with each other. Okay, so lagging indicators are more likely to be in conflict with each other. Lagging indicators don't work well in sideways markets. Don't work well in ranging markets. Do you know what does though? Leading indicators. Yep, leading indicators perform best in sideways ranging markets. Okay. Leading indicators work well in ranging markets. Do you know what does though? Okay, leading indicators, yep. General approach is that you should use lagging indicators during trending markets and leading indicators during sideways markets. Use lagging indicators during trending markets and leading indicators during sideways market. We're not saying that one or the other should be used exclusively, but you must understand the potential pitfalls of each. Right. How to use oscillators to warn you of the end of a trend. Whoops. How to use oscillators to warn you of the end of a trend. An oscillator is an object or data that moves back and forth between 2 points. In other words, it's an item that is always going to fall somewhere between point A and point B. So imagine this line here is point A and this line here is point B. So this line is always going to fall between them 2 points. Think of when you hit an oscillating switch on your electric fan. Think of our technical indicators as either being on or off. More specifically, an oscillator will usually signal buy or sell, the only exception being instances when the oscillator is not clear at either end of the buy-sell range. Does this sound familiar? It should. The Williams percentage R, stochastics, and relative strength index are all oscillators. Signal buy-sell. Williams percentage R, stochastics, and RSI are all oscillators. Oscillators work under the premise that as momentum begins to slow, fewer buyers if in an uptrend or fewer sellers if in a downtrend are willing to trade at the current price. Work under the premise that as momentum begins to slow, fewer buyers if in an uptrend or fewer sellers if in a downtrend are willing to trade at the current price. A change in momentum is often a signal that the current trend is weakening. Change in momentum is a signal that the current trend is weakening. Each of these indicators is designed to signal a possible trend reversal, where the previous trend has run its course and the price is ready to change direction. Each of these is designed to signal a trend reversal. Let's take a look at a couple of examples. We've slapped on all three oscillators on GBP/USD's daily chart shown below. Remember when we discussed how to work this stochastic, parabolic, SAR and RSI? If you don't, we're sending you back to 5th grade. Anyways, as you can see on the chart, all three indicators gave buy signals towards the end of December. Taking that trade would be yielded around 400 pips in gains, ka-ching. Then, during the 3rd week of January, the stochastic, parabolic, SAR and RSI all gave sell signals. So that's the second bit here. And judging from that 3-month drop afterward, you would have made a whole lot of pips if you took that short trade. Around mid-April, all three oscillators gave another sell signal, after which the price made another sharp dive. Now let's take a look at the same oscillators messing up. Just so you know, these signals aren't perfect. In the chart below, you can see that the indicators could give conflicting signals. For instance, the parabolic SAR gave a sell signal mid-February, so here, whilst the stochastic showed the exact opposite, so buy. Which one should you follow? Well, the RSI seemed to be just as undecided as you are, since it didn't give any buy or sell signals at that time. Looking at the chart above, you can quickly see that there are a lot of false signals popping up. So no signal, sell, 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 buy, buy. During the 2nd week of April, both the stochastic and the RSI gave sell signals, while the parabolic SAR didn't give one. The price kept climbing from there. You could have lost a bunch of pips if you entered a short trade right away. You would have had another loss around middle of May if you acted on those buy signals from the stochastic and RSI and simply ignored the sell signal from the parabolic SAR. What happened to such a good set of indicators? The answer lies in the method of calculation for each one. Stochastic is based on a high-low range of the time period. In this case it's hourly, yet it doesn't account for the changes from 1 hour to the next. The relative strength index uses the change from one closing price to the next. Parabolic SAR has its own unique calculations that can further cause conflicts. That's the nature of oscillators. They assume that a particular price movement always results in a same reversal. Oscillators assume that a particular price movement always results in the same reversal. However, that's wrong. Oscillators not always work. Whilst being aware of why a leading oscillator may be wrong, there's no way to avoid them. If you're getting mixed signals, you're better off doing nothing than taking the best guess. Right, okay. If getting mixed signals from different oscillators don't do anything, if a chart doesn't meet all your criteria, don't force the trade. Move on to the next one that does meet your criteria. Smart. True. So when using multiple oscillators, it's best that they all confirm with each other, rather than say if two gives you a buy signal whilst the other one gives you a sell, then you go for the buy because there's two of them, whereas only one sell. But then that could mess you up later on, because it might actually do, you should have actually bought instead of sold. So yeah, so make sure all the oscillators confirm with each other. Okay, I am going to leave this episode here. In the next video, we're going to cover how to use the moving average, convergence, divergence to confirm a trend. So thank you guys for watching, and I will see you then. Peace.